Someone recently asked me if I was a fee-based planner, and the answer to that is no. If you and I spend hours together and nothing comes from it, there is no bill for my time. I don't operate that way. Now, I thought I'd demonstrate to you another case study. I've gone through a couple, thought I would do one more. This lady came to me recently because she had quite a tax spin down problem. You're going to see that. Let's go ahead and get to the notepad. All right, so let's take a look. So this lady, let's give you a couple variables here. She was 55. She wanted to be done at 65, right? It's good timing. Now, this woman had a decent amount of capital, right? She had quite a bit of capital. So when you look at this, don't think, oh, this would only work for her. This works the same if you take a 0 or 2 off, right? It's scalable regardless of your wealth. But this woman had $2 million primarily in banks, so very liquid. And then she had $30 million of other money, mostly in brokerage accounts and in real estate. So if we get back to the buckets, right, she was like this. I mean, realistically, these are none. This is the ordinary income bucket. She did not have any. She didn't have any in the tax-free muni bond bucket, and she had 0 in the tax-exempt overfunded insurance bucket. She had all of this sitting in the capital gains bucket here. Now, if we look at that, if we get back to the whole Teeter Totter at distribution, she's like this, right? She is predominantly, 100% of her money sitting over on this side. Now, from a standpoint of how much money she can, distribute to herself, she can without a doubt maintain her lifestyle for sure, right? Like this woman's got a lot of money. But I asked her the same thing I asked you in the video. I said, okay, well, if we look at everything you have here as a pie, and it comes time to finally begin using this pie, using your money for your lifestyle and everything you want to do, how much of this do you want to share with the IRS? How much do you want to carve out for them? And of course, she said, I don't want to give them a thing, right? I don't want to give them anything. Well, unfortunately, she's not set up that way just yet, right? She's going to have capital gains tax, of course. She's going to have continued taxes in her brokerage accounts as they continue to earn. She's also, without a doubt, at her income levels, she's going to have 85% of her Social Security means tested for sure. So I asked her that too. I said, you don't need it, right? She's like, well, of course not. I said, but you've been paying into that thing a lot. If you could get your Social Security, would you want it? And she's like, well, yeah, absolutely, I would want it. Okay. So the only way you can get it with this type of an income level, of course, is if you're showing a tax exempt status and so that it's not means tested. So here's what we look to do. These were two options for her. She ended up choosing a third one, but I'll get to that here in a moment. So what we look to do is let's just play with this 2 million that's liquid. If you recall back in one of the previous videos, prior to 1988, you used to be able, with the stroke of a pen, just dump all that money one time into an insurance contract and have all the benefits that we talked about earlier. But the government doesn't allow you to do that anymore and avoid being taxed like an IRA type of an account. So what she could do is, we've got a 10-year period of time. We could just bleed it out over time. We could do $200,000 a year, and we could just slowly transfer this money like from one pocket to the other and put her in a position to be a little bit more balanced. She still would be predominant here, but she would have then about $2 million in the insurance. Now that would allow her some distribution capability to come down, potentially to offset what she has to take out of this. But the lifestyle she wants, she actually wanted to be able to do a little bit more. Now again, listen to those words, please. They're important. This isn't about selling her insurance. It's about what she wants to do. That's all we can demonstrate for her. So could she qualify for a policy for buying the smallest death benefit with a $200,000 premium? Of course she could. So then we demonstrated to her, well, what if there's a secondary option? What if we use this 2 million, but we broke it down into 2 payments, so $1 million for 2 years, and then we stop. And now we have 8 years of not funding this thing, which creates a void at $1 million a pop, so about an additional $8 million. So at this age, at age 65, when she begins to divest from these accounts, if she divested from those, let's just call it 10 million, and she paid 2 million in capital gains tax, right? So if she divested $10 million, paid a capital gains tax, and dumped that 8 million into this thing, Then now her teeter-totter is a little bit different. Now she'd be sitting here with about 20 million. Right, yep, and she'd be sitting here with about 10 million, the first two, and then the 8. Now her distribution is seriously more balanced. Without a doubt, she can pull enough out of here to maintain her lifestyle and create a tax-exempt structure for herself and get 100% of her Social Security and qualify for all the government she wants. She can even move to California and not have to pay the state income tax because she's not even showing any income. She liked that one a lot. So she asked, well, how aggressive can I get? Can I get this balanced even more? Can I get like this, right? Have it even better? Well, unfortunately, we weren't able to do that. Based upon her age and her health and everything else that goes into those applications, the maximum I could get for her was an insurance policy with a premium of about 1.3 million. That was it. All right. So that's what we did. So we put her in a position to be greatly balanced here instead of so lopsided. And then her distribution is incredibly strong. She can pull more money from this if tax laws are real favorable, or pull more money from this. But either way, no matter what, if she's coming down the mountain, she's going to be tax exempt, and she's going to be able to play that game with additional benefits, etc., and maintain use and control of her money. So this was a great example that I wanted to spend a couple minutes to share with you. And again, please don't don't look at the M in the million here. If this is 20 grand in a bank account and $300,000 worth of investment, this kind of stuff works the same way. So I tell you what, you're going to see that little button, the capability to schedule on my calendar. If you're interested in looking at how we can try to devise a strategy like this for you, then I'd ask that you click on that button. You get direct access to my calendar, and you can book a time with me, right? So please do that. I'd be honored to be a resource for you and see what opportunities exist.